Good morning, everyone. Thank you for joining. My name is Valencia Aline, and I am president of the Georgia Association for Women's Lawyers. So happy to and honored to be with you all today. I'm also honored to introduce our guest speaker who may or may not remember, we actually met on Clubhouse many months ago. He is amazing. His name is Jayden Doye, and he grew up in Maryland as a fellow DMVer. I'm so excited. He is a graduate of Townsend University and has a BS in accounting and is a certified public accountant and certified profit first professional who's the owner of Prestige Accounting Solutions. Mr. Doye is also known as the law firm CPA. He uses his 10 plus years of accounting and business consulting experience to help firm owners across the nation reach new heights and catch more flights. I love that. As president of Prestige Accounting Solutions, Jayden loves to use specialized accounting strategies to help law firm owners increase their profits and pay less to the IRS, something I think is certainly going to be of interest to all those in attendance today. So without further ado, I will turn this over to Mr. Jayden Doye.
Thank you so much for that warm introduction. One moment while I get this to screen sharing. All right, let me know when you can see the screen. Can you see the screen?
We can.
All right, sounds good. Let me go ahead and put it in full page view and we'll be good to go. I just had it. I don't know what just happened. All right, there we go. All right. So again, thank you so much for that warm introduction. Today I'm going to demystify the rules and regulations as it pertains to trust accounting. Throughout this presentation, there will be a few polling questions. So you want to make sure that you're definitely paying attention so that you can answer those and we can make sure that you get your CLE credits. I know you may be tempted to have this in the background while you're working or getting ready for work, but I would highly advise to give this presentation your full attention. My goal is to take this topic to which many people don't like to talk about or maybe overwhelming for people and make it understandable and easy for your brain to digest it. So before we get into the actual material for today, let me tell you a little bit about myself. Like Valencia said, I am from the DMV area and I love numbers. And I love puzzles. So I am in the perfect place because when it comes to IOLTA and trust accounting, oftentimes people have struggles with it. And when they come to me, I have to put all these puzzle pieces together to get them in compliance. And I love it. Okay, I really do. I don't think I'm ever going to retire. Honestly, I could do this until I'm old and can't walk anymore. So what are the learning objectives for today? So we are going to go over 4 items. One, we're going to talk about what exactly is trust accounting. We're going to talk about the top 10 pitfalls. We're going to talk about proper trust account records, and we also will talk about how technology can help. All right, so before we get into it, let's get into our first polling question. Are we able to pull up the polling question?
Lauren, are you on? I don't know.
I just sent you a message. I didn't receive any polling questions, so I don't have any to be able to pull up. I'm sorry about that, but I don't have any.
Okay, no worries, no worries.
I'm sorry about that.
Okay, no worries. All right, so this image hopefully is not what your office looks like, but I know on some days this is how life may make you feel, because you have so many things going on. You have client records, various different cases, managing the money in your firm. But whether your office looks like this or not, you absolutely want to make sure that your trust books do not look like this. And as we explore various items related to trust accounting, apart from the presentation slide, I will also show you software screenshots to demonstrate some of these points, because I'm assuming, like many of you, like myself, many of you are visual people. So before we actually go into trust accounting, let's review the typical needs of a law firm or even a small or solo firm when it comes, and it comes down really to three factors. The first thing you need to make sure is law practice management system. This handles your calendar, task management, email management, document management system. These are the things that really every business needs, but it's very particular in keeping a law firm organized. And not only that, but it'll keep you organized as far as clients are concerned, but it'll also keep you organized on a matter level. And depending on what industry, what area of law you practice, that can be very important, because you may have clients that are engaging with you for more than one matter. And having a really good practice management system is important to keep all of that organized. Then you have a legal billing system, which covers your time and expense tracking, invoices, and collections. That, of course, is important as well. And the third is a law firm accounting system, which is what we'll be discussing a little bit further in detail later in this presentation. Now, for legal practice management and for billing, there are several choices depending on your needs. There are many practice management software that actually have the billing and the calendar infused in the software. And some softwares are cloud-based, and some softwares are downloaded directly onto the home-based computer. So as you are looking at different softwares, you want to make sure that you are planning for the growth for your firm, so that you can stay organized. All right, so I'm sure that many of you are familiar with many of the things as it pertains to the various different softwares, but now let's move on to accounting systems. So why is it specifically different from plain business accounting? Well, there are actually three components in law firm accounting. There's the business accounting. This is known as the back office accounting facility, payroll, paper, computers, things of that nature. These are the items that are handled by each and every business. And you have your profit and loss, your balance sheet. This is standard business practice. Okay, so that's the general business accounting. But then there are two factors that are unique to law firms. The second is matter cost accounting and income accounting. This can be billed in various different ways. You have hourly matters, you have flat fee, and you have contingency cases. How your payments are received is also unique to law firms. How are you tracking those costs? Are they direct costs? Are they indirect costs? How are you tracking the invoice payment that comes into the firm? And how are you allocating these payments? That too is unique. But the third one is fee advances and retainers. This, as we know, is completely unique to law firms. There's a lot of compliance regulation here in place, which is not an optional thing, clearly. It's something that's a requirement. And many other industries don't have to deal with that. But in the legal industry, it's definitely something that requires a lot of focus. So this is the area to which we'll be focusing on today, specifically IOLTA, AKA trust accounting. So what exactly is trust accounting? Well, trust accounting is known also as escrow accounting or IOLTA accounting, and there are requirements and compliance mandates, as it's really important to make sure that we're handling trust accounts correctly. The bookkeeping for both inside of how you keep your software records as well as your paper trail for an operating account is very unique. The rules are different. There are a few rules when handling your business account versus how you handle the records and the accounting as it relates to your trust account. So in your general business account, you have a lot of leeway, okay? You could do accrual, you could do cash-based accounting, but in terms of trust accounting, you want to make sure that both your billing software and your accounting are complete, meaning every transaction, every payment, every transfer from your trust account to your operating account, all of these things have a paper trail. So when we talk about paper trail, what are some of the things that we're talking about? We're talking about making sure that you have paper copies of statements and invoices, copies of checks, deposit slips, and any type of accounting reports. That way, in the event of an audit, you already have everything. You already have everything compiled. I recommend clients do this on a monthly basis. That way, it's easy to go back into any specific month. Let's cover what type of funds belong in a trust account. So you have settlement funds, which are most common in personal injury cases or real estate settlements. And you typically have maybe one deposit or a few deposits, which must be dispersed to one or more parties. And then there are funds, and then there are just funds that come in and out pretty much. You have third-party vendors or whoever in a case that you have to pay outside of course, your own firm in a personal injury case. Now, in Georgia, unearned fees or retainers belong in a trust account as well, which is interesting because that does vary by state. And anyone who's also licensed in New York, they know what I mean by that. And so to a large degree, it depends on the engagement that you have with your client, the retainer agreement, and all of those things of that nature will determine if the fee is unearned or if it's earned. You have flat fee retainers, but then you also have flat fees to which they are earned upon receipt. So those are two different matters that we're talking about. So when we're talking about the funds that go into a trust, we're talking about the ones to which someone pays you pretty much in advance for your fees. You haven't earned it yet, and you will bill the client as you do the work. And as you're doing the work and you're billing them, their retainer balance is decreasing. Okay. You also have advance costs for judgment funds, which is typical in contingency cases and third-party funds. So all of these type of funds can be held in the trust account. Oh, and we also have judgment funds, of course. Now, let's talk about what funds should not be in a trust account. Of course, personal funds. Really anything that's not client related does not belong in the trust account. Now, in some cases, a very nominal amount of personal funds are allowed in the trust account, and this is to cover any type of service costs or bank charges or minimum balances. And we'll come back to that in a minute. Then we have earned income. Anything that your firm has actually earned, whether it's from direct fees or earned after they've paid the retainer, that should be deposited into your business account, not in your trust account. So while it may have been a retainer at one point, once it's earned, it should be taken out. Payroll, that's a big one. Payroll is a business expense, okay? This should never have any place in your trust account. And it's also a situation to which you're not a fiduciary trustee. You should not be managing those funds in a trust account. If you're not the one that's taking the responsibility for the funds, you should be holding that, because in essence, the money that is in your trust account, you're holding as a fiduciary trustee to a client. So it's very important to understand the type of money that goes in the trust account and not the trust account. All right. And should you have any questions through this presentation, feel free to put it in the chat. And then at the end, I will answer them all at the same time. I don't want you guys to forget your questions as they come up. All right, so let's talk about accounting tools now. So accounting tools usually fall under one of three categories. You have manual, which includes, those back in the day, we used to use pen and paper to do accounting. So believe it or not, some people still do. You also have spreadsheets, which is a little bit better, but still considered manual. And then you have the generic accounting software, which is very typical among many small businesses. And I know a lot of attorneys that use programs like QuickBooks or similar applications because they are very common for business accounting. Then there's a third item, legal specialized accounting software. This caters specifically to the unique needs of attorneys and law firms. So you do have three options. I just want you guys to make sure that you know the difference of those three options. Now, let's talk about what makes trust accounting easy. There's easy parts to it and there's hard parts to it. And we'll talk about both. So trust accounting is pretty straightforward if you really think about it. There is no profit and loss as it pertains to it. There's no depreciation. There's no amortization. As far as interest is concerned, interest comes in and then it goes right back out. So there's no interest that accumulates month after month. And there's no tax accounting. So you're not having to worry about putting in taxes at the end of the year or at the end of the quarter because it's not earned income. Okay, so there's typically no account management in terms of fees or bank fees. Those should always be deducted from your operating account. And this is a very important point. I do have clients that say, oh, I have a little cushion in my trust account just in case I have a bank fee or a wire fee. Well, technically, those fees should not come out of your trust account. They should only come out of one of your other business accounts. But depending on the bank that you are working with, like many of the large banks, believe it or not, don't follow trust accounting guidelines because they don't work for just attorneys. They work for many, many, many different businesses. So it's important that when you're looking for a bank or you're talking to your personal banker, you make sure to let them know, say, hey, I want to work with a bank where you take these trust guidelines into account. And if I have a wire fee, that should be deducted from my connected operating account and not my trust account. But again, it does vary. If your bank does not work that way, you may, at that point, may need to have a cushion in your trust accounts. And that will be a separate line item as it pertains to the different ledger cards. And we'll get into what that means later in this presentation as well. Okay, so let's talk about what makes trust accounting hard. I'm just curious. Let's get some audience participation. If you care to share, let me know what bank you're using for your IOLTA account. And while you guys do that, we'll talk about what makes trust accounting hard. So the difficult part is that you have to track your funds for each and every matter. The bank knows your total balance, but you're responsible for knowing at all times what portion of that total balance is for which matter. And that is something that you have to stay on top of. You have to reconcile your books monthly. And there's a lot of flexibility when it comes to your business account since that's your own money, balancing your checkbook and whatnot. You have some, liberties there. However, when managing client funds, monthly reconciliation is not only essential, it's a requirement. Just think about it. Not only is there human error, yourself or your staff can make a mistake, but banks make mistakes too. So if you check it on a monthly balance, you could be overdrafting or commingling funds without realizing it. So that does need to be done on a regular basis. You also must maintain an audit trail for those exact same reasons. When dealing with your client's money, you must account for every action taken on that account and have a good record for it. So to make it a little bit easier, you do need to have an integrated system which can support the trust funds management along with your billing. That is a helpful factor to make sure that everything is taken care of. All right, so let's see what type of responses we got. Ameris, oh yeah, I love Ameris. Bank of America, okay, a few people at Ameris. Okay, Truist, I've heard good things about Truist credit cards, but Lord, from an accounting standpoint, it's so difficult to get added as an accountant to a Truist account. It's ridiculous. Wells Fargo, okay. Wells Fargo, I don't think I have any clients that have Wells Fargo for their IOLTA account. So that is, it's good to know that they have that. I'm not surprised though, it's a big bank. We have some more Truist. Okay, Chase. Now, if you're at Chase, you need to take a look at the Chase Ink card. Okay, we're not talking about that today, but make sure you take advantage of that card. It's almost as good as the Amex card. Okay, we have a few more Truist, M&T Bank. Oh, they changed their name to Nota. Okay, and Bank of America and Koyo. Thank you for that. Let us know that the state bar has a list of banks that comply. And this is very important because every state has their own list of banks that comply. So it's definitely important that you look there before opening a bank account, especially if you are going to open a bank account with a bank that is a small community bank. We oftentimes think that community credit unions are the way to go, but sometimes, especially when it comes to having an IOLTA account, it's not the way to go. All right. So let's talk about what goes wrong. Accounting is, one of those things where, when we talk about issues as it pertains to IOLTA accounting, we're talking, we're not talking about the knowing misappropriation. We're not necessarily talking about theft because a mass majority of disciplinary cases, actually, there was a study that showed over 95% of disciplinary cases are related to poor record keeping and maybe compliance practices, just neglect. So we're not talking about intentional actions. That's a very different situation. But in the case of negligence, there could be very severe consequences as well. Thousands of attorneys lose their license every year. Just because I'm a nerd and I'm really into this stuff, I look at reports, and I look at different cases, and it's very interesting. If you ever get bored, just Georgia puts out a report every once in a while, and it's very interesting to read through those cases. But as you can see here, the list is very quite long for the things that go wrong, and many of them may not apply to you, but it is still important that you're aware of each and every one of them. So what we're going to do is we're going to walk through each one of these items and cover them a little bit more in detail. The first one, and you might want to, as I go through these 10 pitfalls, if you're like me, I'm a note taker. I need to write things down. I would definitely write these down just to make sure that next time you have a meeting with your accountant, you can make sure that you are not falling victim of any of these. So number one is lack of trust-specific knowledge and rules. So as I mentioned before, Georgia has their own specific compliance guidelines and audit programs that you need to be aware of. In some states, you can only get audited if you get flagged for a bank or client dispute. New Jersey does this random audit program. Oh man, it's very interesting. And in the state of Georgia, this is the wording, okay? All trust accounts are subject to an audit for cause by the state disciplinary board. An audit for cause may be conducted at any time and without advance notice if the Office of General Counsel receives sufficient evidence that a lawyer poses a threat of harm to clients or the public, with approval from the chairman of the investigative panel of the State Disciplinary Board and the president-elect of the State Bar of Georgia. So, all of that to say, how does the saying go? Stay ready so you don't have to get ready. Yeah, put that on a Post-it note and put it on your desk, just to remind you, we always have to stay in compliance. Now, if you are to get audited, what matters of compliance are you supposed to meet is the question. You need to be aware of that as well. Also, be aware that most CPAs, bookkeepers, they understand operating accounting, so general business accounting, but they're oftentimes not aware or care for the unique trust accounting challenges and also those compliance requirements, unless they specialize in serving law firms. So majority of the time, the clients that I deal with, they have had a general CPA, a bookkeeper that works with many different types of businesses. If that is the case, you need to make sure that they are aware or at least willing to take the time to really understand trust accounting, how it should be managed, and the compliance requirements for not only a federal, but a state level as well. You may have a bookkeeper in another state, so that also needs to be taken into account. At the end of the day, the bar is going to look at you as it's your responsibility, not necessarily the accountant's. So make sure that the person that you're working with, if this is somebody outside your firm, has knowledge, has the necessary knowledge as well. You can't just expect that every accountant, they know the stuff, because there are many legal specific factors that they may not know. And as I said earlier, when it comes to different states, rules in New York, New Jersey, Georgia are a little different. So should your accountant be in one of those type of states, they need to read up on the Georgia rules. All right, the second pitfall is specific to small firms. There are some challenges that just arise by having a smaller business. for any size firm compliance requirements. And of course, whether you're solo or one attorney firm, you always have to deal with compliance, whether it's an audit, whatever the case may be, in that your chances are typically the same realistically. But there are other items that could be somewhat of a disadvantage. Like maybe you lack certain dedicated resources in terms of some of the bigger firms. They have controllers, they have CFOs who handle, specifically going through the books and making sure that everything is okay on a monthly basis. Not every firm has that resource. Having training in the office, making sure that everything and all the processes are in place. Everyone following the same methods is important, and making sure that everyone is managing money. If there's more than one person that has access to funds, making sure that there are financial policies in place is very important, and also training them on that, not just giving them a instruction manual, but physically going through training. And when it comes to training teams, um, in general, whether it's financial policy or other policies, I usually advise people to do this in a few different phases. So it can be very easy to say, I want you to be a master of this today, right now, because I have 100 things to do. But in real life, that may not be realistic. So here are the different phases that I say you could train your staff. The first step is to make sure that you do it and you understand it. The second step is you do it and you have them watch you do it. Okay. So they're just watching you and they're taking notes. Then, third, they do it and you watch them to make sure that they're doing it right. Then they go and they do it on their own and they formally create a standard operating procedure for the process. And then the last step, this is how you know that they really know what they're talking about, is that they can train someone else. If you take that 5-step method in training, believe me, it will definitely increase your productivity. All right. And so we also had IT systems, and this could be with being in a digital age now, this could be very different depending on if you are fully remote, if you're in office, or if you're a hybrid. And then you have different tools that people have to manage that can be very cumbersome and hard to manage. So most of the time, the smaller businesses, especially the smaller firm owners, you're wearing many hats to meet compliance, and you're wearing more hats than your larger counterparts. So they have different resources and departments and teams to handle many of the things that you're trying to handle all on your own. And so this can be seen as a shortcoming. And the important thing out of this is that everybody has the same likelihood of being audited, and everybody has compliance requirements regardless. So there needs to be a way to overcome these various challenges, and we'll talk about in a bit. The third is manual systems. So tracking client funds manually or on spreadsheets, as I mentioned before, is not only slow, but also very, very prone to errors. Calculation errors are very common. And more importantly, they're even harder to fix. So you can be chasing around a 5-cent discrepancy and wondering what is going on here. And granted, there's a little bit of a leeway, certain discrepancies you can write off, but for the most part, you should really account for every single penny in a trust account. And once you find a mistake, then you've got to recreate those records. It just takes a lot of time. So I have people that say, oh, my Excel spreadsheet lets me do whatever I need to do. Well, that's the problem. You're able to do whatever you need to do. There's no safeguards in place. There's nothing telling you, hey, you can't write that check, or hey, these funds are on hold, or hey, you're putting these funds to the wrong matter. There's nothing in a manual system to tell you that. So you need to make sure not only your ledger book, but also by writing manual checks or deposit slips, be very careful and look for more automated methods of doing these things. I've actually seen in practice where um, firms will use manual systems and they think everything's fine. They're like, yeah, my money just comes in and out of my IOLTA account. I don't have any problems there. However, once we actually get them on accounting system and recreate historical records, my team finds, oh, you still owe this person $7. You overpaid this person 42 cents. There's $17 remaining on this matter. Can you explain that? And when you're doing things manually, it's easy for a lot of these small discrepancies to show up. And even though it may seem small, they eventually add up. And so I don't want that to happen to anyone. When it comes to using a general accounting solutions, oftentimes the IOLTA, because by default QuickBooks is not set up specifically for law firms, you have to be extra vigilant and evaluate that tool carefully to make sure that whoever is doing the accounting also has created sub accounts for each matter on your balance sheet. So write that down. You want to make sure that there are sub accounts in your client trust liability for each matter. Again, at the end of the day, your responsibility is to make sure that all of this is squeaky clean. In the event of an audit, they will knock on your door, not on your accountant's door. Just imagine you're using a manual system and they knock on your door and say, I need 5 years worth of three-way reconciliation reports. The question is, how do I do that? Now, depending on what type of system you're using and how many transactions you have and how many days they give you, those reports can be recreated. But if they give you a tight deadline, anytime I've worked with a client and they've been audited, it's been a very tight deadline. And you don't want to put yourself under that pressure. So let's move to number 4. This is where your trust funds get commingled. Now, there are 2 types of commingling, okay? The first is losing track of client balances in your trust account, which basically means you don't have separate ledger cards. You should have a separate ledger card for each and every matter so that you don't lose track. And I've actually seen where people will convert over and they want to migrate balances. And okay, I'm like, all right, you have $500,000 in this trust account. I see the client list and how much goes to each matter. They say, I have no idea. And that's a big problem because you're basically saying you don't know where the client's money is or what portion is there. So that's something to be very, very careful of. And it really comes down to the tool that you're using. The second form of commingling is mixing of client funds and your own funds. Now, I did mention that you can have a separate cushion, and in some circumstances, basically in Georgia, if you are required to have, let's say, $10 in your account. So I'll give you a real life example. Ameris Bank will close your account if it has a zero balance and it has over, I think, 90 days of no activity. So let's say hypothetically, you are a estate planning attorney and you do that flat fee. So that money goes into your operating account. But every quarter, somebody in your network gets in an accident and you take on a personal injury case. Okay. Now, you don't want your bank account to close just because you've had over 90 days of no activity, because you only get these personal injury cases every once in a while. So if the bank requires you to have $10 in there to keep it open, then that is fine. There's a line item. Usually there's a line item called firm funds. So that'll have its own line item on your balance sheet. Okay. Now, you may want to open, if you do various different types of law, let's say you have real estate cases, personal injury cases, you can have more than one. You can have more than one trust account if it's easier for you to track funds that way. I've seen it where the firm has a trust account specifically for an actual estate that they're managing funds for, and then they have a separate trust account for the retainers that they get for various different matters. Because the estate that they're handling, that volume of transactions, we don't want to get that mixed up with the other funds as it pertains to retainer matters. And so from an accounting standpoint, it makes it easier for their accountant to trace the transactions and make sure that the funds are reconciled at the end of each month. But you don't want to just use your trust account as a savings account. It's not a rainy day fund account. It's money that, again, you have a fiduciary responsibility for. It is technically, you want to remember, it's not your money, and you don't want to overdraft on any certain matter. Which brings us to the next slide, trust ledger overdrafts. So overdrafting the bank account, of course, is a big issue, but the bank will only tell you overdraft if the account goes negative. Let's say you only have $3,000 on a matter, and you cut a check for $3,000, but there's still a remaining balance in your trust account. They're not going to tell you that balance is zero for that specific matter. And in general accounting software won't tell you that either. So that's where the complexity comes in to make sure that is managed properly. Whether there's a balance in the trust account to cover the check is not the point. You need to make sure that the funds are available for that specific client, so you're not taking funds from somebody else. There are many cases. These are the ones that I told you I like to look up at night when I have trouble sleeping. There are many cases where lawyers have been disbarred because even though the funds were used for genuine purposes, they overdraft a specific client matter. Okay, let me give you another example. Let's say you receive a deposit on Monday. On Tuesday, the deposit has not cleared, but you still cut a check to a third party on this specific matter. You're technically taking money from another matter. You have to be aware of how long it takes for deposits to clear and what the actual balances are in the system. All right, so now let's go to the next one. Next, we have absence of safeguards. So these are things that are put in place to prevent common mistakes. You need commingling safeguards, protecting overdrafts. You need safeguards to make sure that you don't duplicate check numbers. Everything matters centric. Those are just some examples of safeguards. Now, of course, manual systems, you're going to have that whatsoever in general accounting software. So these possibly could set, you could possibly set up like a workaround method, but really legal specific trust accounting tools are what are going to give you the best type of safeguards. There are some softwares that when instead of writing manual checks, anytime you want to write a check, you do it in the software, and the software will tell you if you still have a remaining balance for that matter, and it will not let you overdraft on that matter. So if you have a good volume of transactions that go through an IOLTA account, this may be something that you want to consider using. Now, if you have a small volume and you have a good CPA or accountant that specializes in working with trust accounts and they're going in there at least twice a month, then you can make a general accounting software work. Just make sure that this person keeps you updated on remaining balances as it pertains to at the matter level. The next item is uncleared funds that are not being addressed. Now, this could be a big challenge. Most service businesses don't really care when when they issue checks, if they're cleared or not. But it is, for some people, it's something that they lose sleep over. However, when it comes to your trust account, you have a responsibility until those funds are actually cleared. And this goes both ways. When you're waiting for a deposit to clear, or when you cut a check, you send it out, and you're waiting for that third party to cash it. Let's say it gets lost in the mail, or one time, I'll tell you, I used the check as a bookmark, and I stopped reading the book for a year, and then I saw the check in the book, and I'm like, oh, I forgot all about this. And when I went to the bank to cash it, it was what they considered a stale dated check. And so those are the type of things that we're looking at. So as long as you put all of your checks into your accounting system, when you do your monthly reconciliation, that report will show you every month your uncleared items. And let's say you wrote a check on November 27th and you reconcile November and it's still uncleared. That's realistic. But if you wrote a check in February and that person hasn't cashed it yet, we need to remedy that situation so we can really get it off of the books. That is a big red flag. Okay. And since we talked about reconciliations, let's get into this one. The bank reconciliation being sloppy. So as I stated before, it's very important to reconcile. And I mean, it's always good to do this month to month and make sure that there's no reconciliation discrepancies. In your accounting software, there is possibly an account called reconciliation discrepancy. This account realistically should not be used. However, I have seen law firms who, you work with the accounting firm that only charges you $100 a month. And I've seen reconciliation discrepancies of $1,000. I've seen 5 figures and I've seen 6-figure reconciliation discrepancies. And what this means is that the bank balance did not match the book balance. And instead of investigating it to figure out what the discrepancy is and remedying that situation, the person said, look, I'm moving on, so we just gonna throw this in reconciliation discrepancies. That is not what you want, okay? Now, not only do humans make mistakes, but banks make mistakes as well. I've also seen where client deposited a check for $1,000 and the bank system picked it up as $100. That's what we call a slide error. And it was caught in the reconciliation process because when you are doing the accounting in the accounting system, there should be some type of deposit slip, there should be a check image, and the check image on the accounting side shows $1,000. The bank statement shows $100. And so then the bank has to give that money to the client because they made that mistake. And by doing your reconciliations every month, you're catching these errors more quickly. Imagine if you only reconciled your accounts once a year and either you or your bank made a mistake 7 months ago. That can be difficult to remedy sometimes and can slow down operations. Now, we talked about bank reconciliation, but I also want to talk to you all about a 3-way reconciliation. And please write this down, 3-way reconciliation. This should be a part of your vocabulary. Everyone should know what this means, okay? So if I ever meet you in person and I say, how are your 3-way reconciliations looking? Don't look confused, okay? So this is where you are breaking down, you're making sure that the books not only match the bank, but the third item that's involved in the 3-way reconciliation is your individual ledger card balances, okay? So we want to make sure that if the bank statement says that your IOLTA has 10,000, your accounting system should also show that it shows 10,000. But then we have to break it down even further and make sure on a matter level that John Doe, Jane Doe, and Ashley Smith, all of those balances, their outstanding balances in your IOLTA account are also correct. And by doing this every month, you can discover mistakes quicker and fix them quicker. Now, if you are doing things manually, it can make it very difficult to find these things. If you're using general accounting software, it's a little bit more work, but the experts know what they're doing. Now, legal specific software makes it easier, but let me give you a few examples of some mistakes that can be made that your accountant will catch should they do the monthly reconciliation. So let's say John Doe comes to you and he pays you a $5,000 retainer because he is ready to divorce his wife, Jane Doe. By default, you will put that into your trust account, right? All right, a month later, a month goes by, you do your billing, and you bill him for $3,000 worth of billable hours that you and your team have done. You, at that point, would bill the client, and then you would, have some type of note that say, no need to pay this invoice. you would show that there's been a transfer from your trust account to your operating account because now this is earned fees. But what if you're moving too fast? And instead of transferring the $3,000 from your trust account to your operating account, you do it the opposite way. And you move money from your operating to your trust account. Now we have a big problem, right? Now that if it's caught within 30 days, can easily be remedied. However, let's say you've made 3 of those mistakes over the span of 9 months. Trying to fix that may be an issue. Let me give you another example. Let's take John Doe again. John Doe is ready to divorce Jane Doe. He gives you $5,000. Okay. Now, you and your team do $5,000 worth of work. Okay. And you bill him $5,000, but you forget that he already paid you a retainer because you didn't put it into your billing software. So now he pays you $5,000 and it goes into your operating account. Now you have an extra $5,000 in your trust account. The case is closed. You have an extra $5,000 in your trust account. And if we can catch that in the next month, we can easily remedy that situation. But imagine you catch it 9 months later. Can you imagine calling a client and saying, "Hey, John, I'm so sorry. You know what? I realized you already paid me that $5,000, so I owe you $5,000." Imagine the negative interaction that can create, not only with that client, but also your reputation and any shared network that you all have. So this is why the bank reconciliation is very, very important. All right, the next item is separate billing and accounting systems. And it can look and feel like this if the two systems do not integrate or rely on each other or work together. For some firms, trust is more prominent, and for some firms, billing is more prominent. It varies firm by firm, but altogether, all three, the billing, accounting, and trust, all of those things have to work tightly together. A few examples are the trust fund balance needs to be visible on your invoices. If you're billing a client, then you should have, and you have client funds of theirs, you need to make it known how much of their funds that you have. So in my earlier example about John Doe, that could have been avoided because it would have shown on the invoice that he had already paid $5,000 from the retainer, and now that balance is at 0. Okay. So when this happens, I'm going to give you a little bit of accounting lingo, okay? But stick with me. You need to debit the trust account and credit your operating account. You have to update the client ledger balance, update the bank balance, and mark the invoices as paid. I'm going to do it again. Say it again. Say it slow. When you're debiting from a trust account to pay an invoice, the following things will occur. You debit the trust account, credit the operating account, update the client ledger balance, update the bank balances, mark invoices as paid. Those 5 things, okay? Now, depending on what type of system you have, that'll determine how much of that is manual and how much of that is automated. And when you're dealing with 2 different systems, a lot can go wrong. A lot of mistakes can happen. Not only can it be time consuming, but you have to take a lot into consideration. So one of the many advantages of integrating all of those into within your billing process into one system is that they're working together, thus saving you time. And when you're receiving funds, the accounting automatically happens. All right. Number 10, loss of control and data protection. So when it comes to your softwares and things of that nature, it should contain, especially when it comes to billing, anything with money, sensitive data, things of that nature, there should be user level access control so that you can designate who can see what and who can do what. And let's be realistic, not everyone is going to work for you forever. So in the event someone separates from the company, you want to be able to quickly and easily remove permissions. You may have some staff that's mainly billing or mainly time entry. You don't want them to see your trust account balance. You want them, or maybe you have a bookkeeper that you only want to do reconciliations or printing checks. It's possible that they may need to see your invoices or may not. There are many different scenarios, but you need to be able to have the flexibility to say, okay, John, you can do this. Ashley, you can do that. And in an ideal world, you also will have audit logs with that software so that you can see exactly who did what and when they did it. And many of the new softwares have those capabilities. Trust accounting, especially, is something that if it gets overdrafted, you can see the transaction and who it was done by. And not only does it give accountability to your firm and your staff to let them know, hey, I'm keeping an eye on things, but it also does allow for you to kind of backtrack and see how to fix certain mistakes. And of course, backups, copying information from one machine to another, or just using a zip drive. I'm sorry, but that's not a backup. It's not. Okay. And yes, we're in Georgia. We may not have hurricanes like New Orleans. We may not have earthquakes like California, but we still need to make sure that in the event of some type of emergency or natural disaster, we have a way to back up our data. It's easy to copy the wrong way, lose a bunch of work. I know, people that put their backups in the same areas of their computer, and God forbid we get a flood or it gets stolen, then the backup is gone as well if you only backed it up on the physical computer. So making sure that everything is covered, everything is backed up, everything is secure. Because if you have to recreate those trust accounting records and you don't have the data to put in there and you have to go based off of memory, that can be very, very, very difficult. So let's talk about trust accounting records, shall we? So I usually recommend keeping these records for up to 7 years. That's just my rule. It might not be written anywhere, but 7's a lucky number, so why not? Okay. You want to have, and because we live in a digital age, you want to make sure that if you're not going to have the file cabinets like we used to have back in the day with all the records printed, that at least you have these records organized and and filed electronically and also backed up. Okay. So let's go through all of these records and talk about the importance of them. First, we have your bank ledger. Okay. And these are screenshots. And as you can see, this is sample. This is not a real bank account data. Okay. So don't try to sue me for confidentiality. Okay. But this is a bank activity report. Okay. This shows dates, who was the payee, the purpose, client running balances, things of that nature. It really shows you in one place what happened, all the activity that happened in the bank account. And depending on the software, it could show you what matter it was also associated with. Okay. Next, we have the receipts journal. This will show your deposits. But again, notice that the client matters are there as well as the deposits. So this is important because we want to know for every dollar that went into your bank account, whether it was your IOLTA or your operating account, who did it come from? Now, granted, I'm gonna go back up to this slide. These reports are the reports that the auditors will be looking for if you're ever audited, okay? Now, general accounting softwares can produce these reports, but oftentimes they're not titled this way. So you want to make sure if you don't get these reports monthly, you want to make sure that your accountant still knows how to produce these reports in the event that you need them. Okay. I've had many conversations with different bar associations about how these reports print from QuickBooks, because the audit paperwork says we need this, this, and that, but the client's on QuickBooks, and QuickBooks by default doesn't print reports with these titles. So I've had to work with what they're looking for, and they are more concerned with the information, less of the title. That is important, but they're more concerned with the information to make sure it's right. They're going to do what's called sampling if you're ever audited. So sampling, long story short, they take a sample and they go through everything to make sure everything makes sense. So they might not go through every single line item realistically. They might not have the time or the manpower to do that, but you don't know at what part of your records they're going to sample. Okay, so we talked about the bank ledger, shows the bank activity, the receipt journal that shows deposits, and the disbursement journal is next. This shows what was paid out. And as you can see, ideally here, it also shows the matter to which it was associated with. Okay. This shows all the checks that were written and what happened. Now, the next one is your ledger card balance report. As you can see here, client funds need to be kept separate in a way. And this report shows how those funds, all within one bank account, have been kept separate. It shows funds that have cleared, shows that are funds that have uncleared, funds that are still in your possession. So this gives you a more in-depth report, more in-depth visual of what's going on. So this figure here, this $5,740. This total should match the bank, right? And then the ledger card balance report breaks down the individual matters. So this way, we know when somebody's going low. So Tom, right here, his balance is 340. Oh yeah, Tom, it's time to go ahead and we need another $5,000 if you're going to continue this case. See, if we do this every month, then we can stay on track. It also keeps us on track with billing and making sure that money is always coming in because we all love to get paid, right? All right, and this one is the individual client ledger card. This shows specifically, it's like a mini bank account for each particular matter. It shows the running balance, and the auditor is going to be looking at, okay, so Joe Smith deposited 2,000, they billed 250, you know, he's going to be looking to see, okay, you said that Joe Smith gave you 2,000. Let me check the bank to make sure that that you got 2,000 on this date. Okay. And if you're audited and you have a bunch of matters, ooh, it's a bunch of paper that gets printed. But if a client ever tries to say that you have been misappropriating funds or they want a statement, you can actually see their activity right here by pulling up their ledger card detail. Okay. Now, when it comes to monthly reconciliation, again, reconciliations, super, super important to do every month. Okay. So let's just recap the purpose. It ensures that your bank and your book are in sync. You can locate mistakes either on your books. And when I say books, I mean accounting records, just in case anyone didn't know that. I apologize. You can locate mistakes by the bank. You can locate problematic transactions, like funds that have been uncleared. Like, why did Tom not cash that check that I wrote in January? And you can't technically close your books for the year until your reconciliation is complete. So that could also affect you when it comes to filing your taxes, because you can't file your taxes until your books are closed. And you want to make sure that as you get your financials every month, another thing that you want to make sure that you get is a copy of the reconciliation report. So in the event that somebody changes something in your accounting records, at least you can see where at one point it reconciled. And this is just an example of what a reconciliation report looks like. Okay. And this is your three-way reconciliation that shows your book balance, your bank balance, and your client ledger balance. Okay.
Hi, Jayden. This is
Yep.
Sandra giving you a 10-minute. Oh, you were almost done. Okay.
Yes.
I was going to give you a 10-minute warning.
Okay. All right. Cool. So let's summarize what we learned today. We learned we now understand trust accounting and its many different components. We talked about the top 10 pitfalls. You know, I'm just curious. Who knows one of the top 10 pitfalls? If you know one of the top 10 pitfalls, put it in the chat. You learned proper trust account records. You learned how tools can help you. Now, what are the next steps? Identify any of these issues in your practice. Ensure proper reports are being filed and maintained. Research and implement a tool to ensure proper compliance going forward. And I'm going to add another one. I'm going to say, research a couple of cases to where lawyers have gotten disbarred for IOLTA mismanagement, And you will see just how easy it is for people to fall into that. So we don't want that to happen to anyone on this call. So I want you to have all the information that you need to be successful. All right. So should you have further questions that we don't answer today, here is my number and my email address. Thank you for your attention. And now I'm going to go to do I have time to answer some questions that might be in the chat?
Yeah, I can read them to you to save time.
Okay, cool.
Since we're running. So one of the questions we have is Renee mentioned that she had a question about, oh, where did my chat go? Paying interest from
Mhm.
trust accounts to the Georgia Bar for indigency program.
Yeah, so the interest is automatically supposed to go, the interest is automatically supposed to be transferred to the bar from the bank. So that's not something that you manually have to do. That's something that's done by the bank.
Okay.
Which is why it's important that when you open up the bank account that you know they know exactly what you need and that they are compliant, because some believe it or not, some banks are on the list as approved, but sometimes they're not doing what they're supposed to be doing.
Okay, thank you.
Mhm.
Caesar asked if you could identify the names of some of the legal specific accounting software that you mentioned.
Okay, so Cosmolex is an all-in-one where it does your case management and all of that, and it has accounting. And that is one software where I know for a fact it will not let you overdraft the trust account. So that's the most like all-in-one. We also have Trust Books. Trust Books only does your accounting for your trust account. Okay. So you're still going to need to have your case management software, and you still need your general business accounting software. But some clients, like if you have a large volume of personal injury cases, it may not, you may go over the maximum amount of accounts that you can have, and if you use QuickBooks Online. So having a separate a separate accounting program for your trust account, I've seen that happen sometimes.
Okay. Before we go to more questions, I do realize some people are dropping off, and I want to say this. I'm Sandra Jean. I'm the Vice President of Programs for GAL. I want to make sure I recognize all the presidents of the bar associations that collaborated with GAL to make this happen. So kudos to you. I also want to recognize Veritext, who's facilitating this webinar. Thank you so much. Without you, we probably couldn't get this done as seamlessly as we are. So thank you, Lauren and team. I want to recognize the members of the programs committee of GAL that helped to lead this effort to make this CLE happen. And I want to tell everyone who's on the webinar that you will be receiving an email from GAL with a survey to just rate this program and provide feedback about the content as well as the presenter. And when you fill out the survey, be sure to include your bar information so that we can submit it to the Georgia State Bar so you can get the CLEs that we promoted that you would receive. And again, Jayden, I can't say thank you enough. This was well done, and I know you still have some questions to answer, and I'll turn it over to you, but we had upwards of 64 people in attendance, which was mind-blowing to me as a lunch and learn, and so thank you to everyone that made this a success. So I'm gonna turn it over to you with a question where someone was asking, would it be easier to create classes in QuickBooks rather than sub-liability accounts for each case? Because it could be overwhelming to reconcile so many sub-accounts.
No. The classes, no, that wouldn't work. Now, there's two different things that you need. One, in your accounting software, you should be tracking your income and expenses by client. So you'll put the name in the payee/payor. The same line that you put a vendor, you put the payee or payor. It's all the same line. But anything that's a sub account of your IOLTA, so any matter that is a sub account, you will need to create a sub liability for a sub account under client trust liability.
Okay, perfect. Some of the other questions are repetitive.
So I think one of the questions were, where do you see where the disbarred people are?
Okay.
And I just Googled it, and it takes you to, I just Googled Georgia Bar Disbarred Lawyers, and the first one will take you to, it'll take you to the report that I'm talking about. And if you click the blue link, it'll pull up the case report. Also, Koyo mentioned that she's in the law practice management program, and that they have resources to help people streamline their practice. So if you're small and you need some assistance, make sure you reach out to her, and her email is in the chat.
Yes. And Shariki, president of GABWA, I believe she said something as well.
I don't see that. Do you see that?
I was just confirming that for the that information is published in the Bar Journal, and I was looking as well because there might be somewhere on the website for that information. I think the Daily Report might publish some of it as well regarding the disbarred attorneys.
Okay. Oh yes. Oh well. Yeah. A lot of the questions were about software. I'll say this. Listen, QuickBooks Online can work. It can work. You just have to make sure that you are working with an accountant that understands trust accounting. And just doing a journal entry to move it from a liability to income is not understanding trust accounting. Making sure that you have sub accounts for each matter, for each client, is showcasing that person knows what they're doing. And if they can help you and hold you accountable to making sure that all those balances match, that's important. And please don't try to do the accounting on your own. I don't care if you only have one case that you get a month. Somebody can help you, okay? Somebody can help you, but please don't waste your billable time trying to do this on your own.
And Jayden, to that point, we have a couple of minutes left. I don't know if you just want to say, several people asked for your information. We will send that out with the survey, but you can talk about what you do personally and how we can retain you instead of trying to do this on our own. I know I've just launched my firm myself, so I'm not too busy, but how can you help someone like me with not a lot of money, but needing the help?
Yeah, so I've actually opened up some availability for you all next week. So if you go to talktojayden.com, you'll be able to book a free 30-minute consultation. Please use that link. Don't go to the website because it'll charge you $300 for a consultation. So for everyone on this call, we can do a free 30-minute conversation where we can kind of talk about where you are in your firm and what next steps you need to take. Oftentimes, when people come to me, what that looks like is we make sure that they have streamlined accounting practices, that so we get their books caught up to date. So we have 3 departments at Prestige. We have our finance department, so that handles monthly bookkeeping for all of our clients. Special projects department, they handle the catch up. So oftentimes people need more than a year of accounting done because they just put it off. and that's okay. We get so much of that we have a whole department dedicated to that. And then our last department is the tax department, and they handle the tax prep and tax planning. And so all of our clients, well, not all of our clients, but most of our clients talk to me personally every month, where they're getting some consultative approach so that we are working towards being profitable and paying less to the IRS. And we're not just handling things after the fact.
Thank you again. And that was talktojayden.com. So I want to point out membership in the Bar Association's pay off, because now you get a 30-minute free consultation instead of having to pay the $300. So that more than covers the membership in a couple of bar associations. So thank you for that. And because we're at the top of the hour, I'm just going to close it up and people can just follow up with Jayden directly. Thank you again, Jayden. We appreciate you so much. And thank you, Lauren. And I think that's it, unless Valencia, you want to say anything. Okay, she's not saying anything. So thank you for that. And pay attention to the chat. There's some good information in there. Thank you, everybody.
All right. Thank you. You all have a good evening and a good rest of the week.
Thanks.